Hello, this is Sky Moore. This segment is on standard contractual net profit provisions so that you understand what you're getting when you hear the language. As an example, I'm going to pay you 10% of gross. What did you get? Well, let me tell you what you got under custom and practice in the industry. Number one is that you got video in at 20%. That is, even if I get $100 of video, I'm only going to include 20% of it in my gross receipts for purposes of what I pay you. So you're going to get $2 because you got 10% of my gross receipts. That's custom and practice in the industry unless you write the contract otherwise. What else? Well, if all I tell you is you get 10% of gross, I have the right to deduct what are called off the tops. Again, this is industry practice. What does that mean? I get to deduct checking, the cost of checking the theaters, collection, cost of collecting, currency conversion costs, residuals owed to the guilds, trade association dues, and taxes. All those categories just come automatically off the top if I don't say anything else. Another way of saying this is what I'm really saying is you get 10% of adjusted gross. And adjusted gross is the custom and practice in the industry means gross receipts, again with video in at 20%, minus the off the tops. Whenever you hear the word though, adjusted gross, you've got to read the contractual definition because many film companies get a little tricky and deduct a lot of other costs than just off the tops. Another term you may use here is cash break even. You get 10% of gross receipts after cash break even. What's cash break even? Cash break even is the point in time that the film company has recouped their actual costs in the film. That is, they've recouped their production costs plus interest and distribution expenses. If all I said is cash break even, it means no distribution fee. If I said cash break even at 10, that means the film company gets a 10% distribution fee. And if you get 10% of anything after that, then you'll get 10% of gross receipts after I've recouped those amounts. Another word you may hear is actual break even. Actual break even is the point in time that the film company has recouped their actual costs plus a full distribution fee, and that could be as high as 25 or more percent of gross receipts. And again, so if I say you get 10% of gross receipts after actual break even, what I'm really telling you is you're going to get 10% of net profits because I'm deducting everything that I would normally deduct. There's two types of cash break even and actual break even. One's called initial cash break even or initial actual break even. That's when you stop the clock. The moment you've hit that, no further deductions are taken. The other is rolling. And on a rolling basis, that means every accounting statement, they keep deducting any costs that have been incurred through that point in time. So if you're a participant, you like the initial calculation better because they stop the clock and no further deductions are taken. Standard producer deal, you get 50% of net profits minus all third-party participations. Let's do a simple example. Let's assume that the studio or the film company has given 30% of net profits to talent, writers, directors. How much do you get? You get 50% of net profits minus the 30 that's been paid to the talent. So you'll get 20% of net profits. That's a standard producer deal. And so that's the standard terminology that you hear. This is Sky Moore signing off for this segment. Hope you join me for the next one.